Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
How's it going out there? It's March 6th, and I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. I spent much needed time with my wife yesterday. You guys know I've been busy, crazy. So got our tickets a couple months ago to go see Pink in Jacksonville. And man, she was awesome. She just killed it. Flying around the audience, wires are tapped, trapeze, everything, just singing, not lipping. Just awesome. Really, really great concert. You know, even if you don't like her music, I just love the fact that she's like, here I am. This is me. If you don't like it, F you. I'm not changing. And that's powerful to me. Like, I love people like that. Just, hey, this is me. That's it. I'm going to be what you want me to be. I'm going to be what I'm going to do. And whether you like it or not, you have to respect it, right? Because she shared a story about her daughter, where she brought on stage with her. And her daughter asked her, why is she so ugly? Right? That's what she asked her. Why is I so ugly? So, and she was talking about this on stage, and she's like, you're not ugly. She's like, look at mommy. They said I was big boned. I look like a guy. Going to turn out to be a nobody. All these people criticizing her and criticizing her. She said, now look at the stadium. It completely sold out. I'm sold out every stadium. So just be who you are, because you're beautiful. You're perfect. And it was such a powerful story, right? To me, it's to anybody, because the most difficult thing, especially in today's world, is being different, right? When you're not part of the crowd, what's going to happen? You get made fun of. People don't like you. If you go back, even looking at some of the most successful people in business, I mean, Bill Gates talked about that during his early years. He's always teased. I remember Jack Dorsey, who I love. He's a guy that really doesn't know how to fail, but everyone said this guy can't run two companies. It's crazy. As you don't know, he's running Square. Square was in the teens, and people said that he knew management. He's going to need help. Went from the teens. It's now over $75, $30 billion market cap. And he also runs Twitter, founder of Twitter. That fell into the teens after it came out over $4 a share. And man, if you go back and look at those articles, they wanted that guy's head on a plate. They're like, this guy, no, got to get him out of here. We need help. Everybody. You put on CNBC, everybody was ripping this guy. Everybody. When they had that downfall, they went to 16, 15, around there. Now, stock's over 30 again. The greatest platforms out there. I mean, if you look, the most successful people and most popular people in the world, they're all on Twitter. You get Warren Buffett, the Pope, every musician, actors. Not saying that, that's why it's so popular, but it makes it powerful because millions of people are able to follow their favorite musicians, their favorite actors, whatever, right? They're going to use that Twitter to connect, to bring people together. So it's just a matter of time before the company figure out, hey, let's figure out how we make money on this. It's kind of like Facebook, if you think about it. Facebook came with that IPO, whatever, 50-something, fell to 30s. They when he went to the 20s. Man, they really wanted Zuckerberg's head on platter that day. It's crazy. Go back and read those headlines. That market was crashing. And look what Facebook did. Was it 160s now? Or went over 200, pull back, yes. But getting back to the point here, being different is good. If people are making fun of you, it's usually because they're jealous or they're really insecure. But it usually means, believe it or not, that you're doing something right. And this is going to go to our first interview here. Getting to a point here. Because if you have some crazy idea, there's ideas people are going to tell you that, you're an idiot for pursuing, it doesn't make sense, go for it. Just go with it, especially if you're young, because you have a lot of working power. If you fail, there's still time to do other things, tackle the ventures, even change a career if you want, so many different things, but go for it. Don't listen to so many people. I mean, you want to listen to people, you want to, get advice. I've taken advice from so many people, that are brilliant and smart, but at the end, if you're really passionate about something, do it. Because I have to tell you, your idea could be amazing. This is why with our company, I want to focus on the new people that we hire and the young people. I want to hear their ideas. I don't care if they're bad. I want to hear their ideas. I want to hear their perspective because they're going to think differently from us. And they're going to know the new technologies out there. They're going to know, they knew Instagram before anybody knew it had any value. All these companies, there's so many of them, but give them that platform to actually share their ideas and explore them. Because I have to tell you, you don't disrupt markets by doing what everyone else does. Or what we see all the time, right? When companies change their names through each bullish cycle. 2007, they have a uranium company. And then, 10 years later, vanadium prices, right, start doing great. Start going high. Vanadium is a byproduct of uranium, so it's easy to change your name. Oh, we're a vanadium company now. Or then, hey, let's buy like a small property with cobalt. Cobalt is hot right now. And now those same companies, they're marijuana companies. No. You're not going to disrupt markets by just following the trends all the time. You're not. You're going to disrupt markets by doing things differently, by doing things that were tested, that didn't make sense. I have a good example of this in my industry, the financial newsletter industry, right? It's a cardinal sin to give stuff away for free. This has been tested time and time again. You have too much free stuff, subscribers or people who follow you, they're never going to pay for anything. They're just going to want free stuff all the time. You talk to any publisher outside of us, every one of them, they would tell you, don't offer a lot of free stuff. Maybe an e-letter or something like that. Well, us, yeah, we got e-letters. They're published on CurzioResearch.com for free. My weekly breakdown, where we highlight the best financial stories every week, is free. We have a token tracker site where we list news about security tokens every week, which 3 months ago, we're like, hey, let's see these stories. Now, we can almost do this daily because this industry is getting widely adopted. So I would love being first in the market in this thing. Well, pretty close. It's exciting, but that's for free. And you know what? This podcast is for free, which is interesting. Because I was told by numerous people I worked for throughout this industry that doing a podcast is completely useless. Waste of time. Waste of free time. Well, this podcast is a reason why I was able to launch my business. It's a reason why we generated over 6 million in sales in our first 2 years. It's a reason why we have an opportunity to become bigger than the publishers that told me that my podcast was a complete waste of time. So for us, our free model works. And you know why? Because we're not full of shit. So when people read our free stuff, they listen to the podcast. They know I'm in the field. They know that I'm at conferences. See that we're doing our homework, sharing ideas, how much time we're putting in, how much we care. You get to see that stuff. That's compared to what? Getting a random email from a newsletter publisher you may have never heard of. Interesting because according to the promotion, that person is about to become the next Warren Buffett, who probably never had a losing position in 5 years. But the email is super aggressive, hyped up. That's the only means of communication. They promise you're going to generate 20x returns in 6 months. Or the best ones, gets even better when they say, the market's going to crash. Get out before May 1st. Market's not going to crash May 2nd. It's going to crash May 1st. That's the date you got to get out. But that's the communication and a high-price sale. But for me, for us, for our company, we didn't listen to the numbers. We do follow the numbers, of course, but we just, we tested this ourselves. And you know what? We found out pretty quickly that offering free content to new people or, people who aren't familiar with our brand yet, and that's a great way to introduce them to us through that free content. Because once they come in, they end up becoming paid subscribers. And this model works if you have great content and good services. Work for Dollar Shave Club. At $1, they're losing a ton of money. Just advertise, they're losing a ton of money. But why would they offer their product for $1? Because they know when people test it, they're going to like it and they just subscribe to their services. And you had one small little company saying, try our service for $1. And now how many millions of people sign up to it where they're paying $9.95 a month or whatever they pay? And here's a company that disrupted a multi-billion-dollar industry dominated by major players want to talk about disrupted. It changed the face of what all these big companies are doing now. And Dollar Shave Club got bought for $1 billion. Again, 2011, 2016, got purchased for $1 billion from Unilever. Giving away, well, not free, but $1 is kind of free. But test everything. Go out there. And especially when people are against you, you're not part of the crowd. That's how you disrupt markets. That's how you become different. I mean, for us, we're looking at our model and testing different things. And that's why we're raising money for Curzio Research through our security token offering. To get our brand in front of more people, because we know by our numbers, when people get introduced to us, our podcasts, our content, they pay for subscription services. And right now, instead of us having a small list of 40,000 people, which, by the way, has grown 60% over the past 4 months, we plan to grow our list into hundreds of thousands and potentially millions long term. And you think about millions, what are you, crazy? That's a lot of people. It's not as crazy as it sounds in this industry. We know every number, we know every metric. But that's where our competitors are right now. Hundreds of thousands to millions of names on their list. So we want to get our brand out there to more people. Doing that through the Curzio Equity Owners Token. Gave you guys an update. I continue to update you. We passed our $3 million soft cap last week, so it's a go. Actually pushing through $4 million right now. But that's all investors will have exposure to. For the first time in the industry, have an actual equity stake in a pure play financial newsletter publisher, which can't be offered by anybody else. But things to think about, right? Because by being different, it's not the worst thing in the world. You're going to get people yelling at you. You're going to get, why are you testing it? It's terrible. I cannot tell you, guys, serious, how many times people told me I'm wasting my time doing this podcast. And I'm going to say almost every place I've been to, that's what they said. Because you couldn't measure it on a spreadsheet with immediate numbers. Oh, this leads to this and this leads to that. No, they didn't understand that people want to know the person before they purchase things. They want to get to know that he's real, know that he's out there, understand his analysis, listen to him. Compared to just getting a random email that's all hyped up. And we proved that model works and it's been working. And that's why, hey, we're looking to expand our company. Now, I'm telling you all of this. This story is relevant because of the guest I'm about to introduce you to. I should say, actually, the first guest I'm about to interview to you. It's going to be a long podcast. I have two amazing interviews, okay? So the first one, his name is Richard C. Wilson. Richard is the CEO of the Family Office Club. It's a private club, over 1,700 investors. They have 25 live events they held every single year where they focus on managing family offices. What's family offices? Well, focus on managing clients who have tens of millions of dollars. Most of the time, it's much more than that. And provided all kinds of advice and services to them. And Rich is also a best-selling author. Now, I'm about to bring Rich on in a second. But he's not coming on to talk about how, hey, if you have 50 million in assets, you can come and see us. No. So if I had to guess, most of you, probably worth less than 50 million, most of you. I'm hoping that all of you one day will be worth a lot more than that for following my advice. That'd be great. But I'm bringing him on because he talks to hundreds of these successful entrepreneurs. He's going to tell you exactly what they have in common. He's going to talk about their investment strategies. I'm telling you, the investment strategies are going to blow you away. For me, I thought they were different than they would be. But I think you're going to find a lot of value in this. I want you to let me know, frankcurzioresearch.com, but I want to get the behind-the-scenes take of someone who talks to them, how they became self-made millionaires, most of these people, how hard they work, what they look for in investments, and how every one of them, I'm telling you, it's going to be really great. Every single one of them are doing things differently. They didn't choose to follow in the path of everybody else, and that's why they're so successful. Now, my next interview, another good one, guys. I'm going to talk about the markets, economy, technical analysis with Chris Gessel, who is a chief strategy officer at Investment Business Daily. So Chris is a brilliant analyst. He's been at IBD since 1996. And if you're a value investor, and by value investor, I mean someone who believes in buying dirt cheap stocks, low PEs, have strong balance sheets, and that's your way. David Einhorn. We all know what happened to David Einhorn in the past 4 or 5 years, maybe even longer now. You need to listen to this interview. Open up. Just don't be stubborn in your investment strategy and listen to what he has to say. Because IBD is all about growth, technical analysis. Chris is going to break down his strategies, his methodologies of science, finding how many of the best growth stocks these guys have been into through the years. And even better, the fact that he's been at IBD since 1996 is really, really cool. So we're going to share a lot of stories and talk about the past and how IBD grew and how the market really turned from being so value-oriented back in the early 90s and 80s and stuff like that to really focusing on growth, to why you're buying these companies that seem to be at expensive valuations, but those are the ones that tend to go up the most if you're smart and if you have the right strategy. So Chris really going to break it down. More important, he's going to share some of his best ideas with you. So 2 amazing interviews. And you know what? Let's get started with Richard C. Wilson. Richard C. Wilson, thanks so much for coming on the podcast.
Thanks for having me here.
Well, you're a different breed of guest I usually have on my podcast, right? Most are stock analysts, market analysts, CEOs, industry experts, but you're a person that some of the most successful people in the world turn to for advice since you manage family offices. Explain that concept to people who aren't familiar with it. And also, if you can, when did you decide that family offices was your thing? Because doing a lot of homework research and getting to know you now, what you do requires an incredible amount of knowledge to the point where, I'm pretty sure you could easily be chosen to be a hedge fund manager or a wealth manager for a major institution. But, why'd you choose family offices?
Sure. Yeah. So first off, a family office is essentially a more complete, more holistic, more long-term way of managing your wealth if you're ultra wealthy. So you can imagine if you have $10,000 to invest, it's night and day different than $1 million or $1 million versus $50 million or, $10 million versus $400 million. You need different types of solutions for the different levels of complexity. And if you have 100 different LLCs and you have to deal with taxes in 7 different countries, you need a different accounting firm and tax advisor than you do if you're worth $10 million and you're running a couple Subway franchise, restaurants in Florida. Those are drastically different situations. And so essentially, family offices are around to help those that have unique challenges and needs when they are worth a lot more than most people. And so there's only 2 types. There's a single family office, which is just for an individual. If somebody sells their network of 200 Subway franchises for $300 million and they want a team just for them, it's a single family office. And on the multifamily office side, it's really like a wealth management firm that's much more holistic and long-term and tax sensitive, but they might be serving 10, 20, maybe even 200 clients that are all at the $10, $20 million net worth or higher. So those are the 2 types. I don't know if you have any questions about those before I go on about how I got started in the space.
No, go on again how you get started. I think that was good. I'm curious to know how you got started in the space.
Yeah, sure. Well, essentially, I got pretty lucky out of my undergrad. I went through the Chamber of Commerce and just cold called and met for coffee with everybody until I got a decent paying job out of my undergrad. And I lucked out and got a 6-figure position at age 21 doing risk control mapping for publicly traded companies, and it bored me out of my mind, but it paid for my MBA in cash. And I realized at age 21, no one else was going to pay me 6 figures unless it was something based on my results in some sort of meritocratic, eat what you kill type situation. So I looked at commercial real estate and raising capital for hedge funds. I got hired on the hedge fund side for a placement agency, a third-party marketing firm. While doing that, we found that institutions had too many checklists to get by, and the high net worth investors weren't qualified or couldn't write large enough checks. So I stumbled across the term family office, and after doing so, I realized, I shouldn't waste time with anyone else. I should just approach these family office groups. While trying to do so, I realized that there weren't a lot of them out there that were public at the time in 2007. It was hard to learn about them. When I did find an article, it was 3 years old and written by a journalist who never worked in the space or ran one. And so I just told myself, well, I'm just going to meet with these types, share everything I'm learning online just to teach myself, and I'll get better at it over time. And long story short, once I started sharing things online, it just took off, and I started getting a couple hundred people a day coming to the website. I started getting calls all the time, spoke 150 times in 14 countries, and bought familyoffices.com. And we've written 13 books now and hosted 110 of our own conferences, over the last 12 years. But it just kind of took off. I was in the right place at the right time with curiosity on a high value niche, I guess, and just shared what I was learning.
And you're being modest there because some of your books are bestsellers, and which is really cool. I think everybody always loves to see that instead of everybody saying, "Well, my best-selling books, everything." But you've been very modest with the books that you've read, and you get a lot of interest in them. I guess what I want to know, and I'm hoping my audience wants to know this as well, is after meeting these people, right? I mean, we've all studied investments, of how you're supposed to grow your investments, how you're supposed to diversify, compound, yet meeting these people and talking to them personally, and some of them are very successful at an older age and some of them are younger. Have you learned anything different? Because if I had to guess, I don't think a lot of these people who became rich just diversified. They probably put all their eggs in one basket and they had one idea, and you hear that all the time. But to actually become that wealthy, it seems like you do have to just focus on just that one idea. But has anything changed your perception about investing after meeting so many of these people?
Yeah, for sure. A lot of them play very strategic, multi-part games with their capital and their business. So many of them develop business models that are unique, that change a dynamic in their industry, that dominate the industry, or that own a niche space. They almost sometimes monopolize a niche space, or they find a unique structure to use and are able to roll up a lot of competitors through superior access to capital or superior structure or superior fees or business model. And then they're able to have a marked competitive advantage and kind of an unfair advantage against competitors. Many of them, definitely not all of them, but a good chunk were in the right place, the right time, were great executors, and they also had a compelling aspect or two about their business. So I think that is important to note. But at the same time, almost none of them created their wealth out of nowhere by chasing some trend. A lot of them were in their space, and then some momentum in their industry or an adjacent industry helped lift their wealth up. It wasn't that they were momentum chasers and they were doing, blockchain and then switching to cannabis and then switching to opportunity zones and chasing everything. It was more that they took advantage of an opportunity that was either a global opportunity or industry specific and applied it to their domain and kind of rode that momentum, and some of them spiked their wealth up in that way. The last thing I'd say is just that one thing that's really interesting is that wealth management traditionally is all about playing defense. It's all about diversifying. It's all about putting you in things that are not correlated. It's all about protecting you and capital preservation. But a lot of single family offices, especially first generation, they're looking to keep playing the game that they're best at, and they see offense as part of their defense. And a lot of them respect what a wealth management brain can do for them. They have the percentage of assets that is just fully defensive, diversified. Then they have a bucket, which is cash flowing commercial real estate. And then they have a bucket, which would be their offensive game, which would be investing back in the space where they made their money, or the next space where they want to have full control and do direct investing. So I know that was a long answer. I'll try to keep my other one shorter. But
No,
top-line ideas.
That was perfect. I love that. I love that because we always hear, I think one of the things, if you read these traditional investment books here, is that you always hear that you got to diversify. Yeah, but yet when you're younger, you have to take on. You have plenty of working power to take on those risks. There's plenty of time to make mistakes, and I'm not telling you to throw everything you own into one thing and lose it. But I think there's something to be said where even a millennial generation where, if you have an idea, go with it. If it doesn't work, there's other opportunities compared to someone who's 60, 70 years old. They don't have a lot of working power and, they want to live off their money. Again, we're talking, but the way you disrupt markets, and I think what you're saying here is not by following trends, not doing the same thing that people are doing. It's more like do something completely crazy that everyone thinks is totally, never worked. They tested 100 times. It never worked. Maybe it just didn't work a certain way. But I guess that's how you disrupt markets, right?
Right. I mean, I like to find a market or an opportunity and then look at your background, your DNA, your resources, your experience, and see if there's some area that you can carve out for yourself, high-end part of that market that perhaps some very successful groups are doing something more broad and you could be more specific. So those prospects who would receive the help or the service or the solution at that specific level would see you as the group which is customized and helping their needs specifically, so that you look like the Excedrin for their migraine and not just a blue pill or a vitamin. If you have a migraine, you want Excedrin. If you can find that valuable niche position And if there's no one else doing it, you might starve trying to do it, or you might just be that smart and on top of things. Usually there's perhaps a couple people that are sort of direct competing with you, maybe not exactly. But if there's 167 other people with a blockchain investment fund, maybe don't launch a blockchain investment fund. Maybe buy secondary shares off of ones that are cratering and can't meet liquidity requests of their investors, or maybe a fund that shorts blockchain funds, or something that's different. Because if you're just following the crowd with the crowd and you're not ahead of it, and you're not the market leader in it, and you haven't defined a unique niche, then you're just going to be mediocre and lost in the ocean of noise of that space. You have to really, be distinct, and you don't get conviction with investors or partners by doing something that's plain vanilla, what everyone else is doing.
Now, it definitely makes sense. And you run something called the Family Office Club, and I read some statistics on it where it's a private club, over 1,700 investors. And you mentioned earlier about the conferences. You have around 25 live events each year. I have to say, from someone who's in this industry that's established, I mean, word of mouth is probably a big deal, but I would think this industry that you're in has high barriers of entry, because wouldn't you be really competing with the Goldman Sachs and Morgan Stanleys? And I could picture their pitches saying, we get into the best deals, we're everywhere, we know everything. Is that kind of like your competition, or for you, I'm sure you don't have to worry about that, but just getting into the industry that you're in seems like it would be, high barriers of entry, very, very competitive at least.
It's definitely takes time. It takes patience, because you're planting seeds. And if you don't do things for the long term, people will smell it out, and then nothing will work short term. So if all you're worried about is the short term, it's going to mess you up both short term and long term, because people won't think you're genuine. You're not adding value consistently. It'll be obvious you're not doing things in the highest quality way possible that's helping the client as much as possible, because you're so worried about getting the bills paid this month, et cetera. And so a really long-term view is important in this space. But we're not competing really against Goldman and most wealth management firms. I mean, 99% of multifamily offices don't help their clients much at all with direct investment. If someone says that they want to buy an apartment building down on 8th Street in their city, most wealth managers will say, okay, well, here's some words of caution. There's a couple CRE firms that we know of you could go to. Let's talk about what else in your portfolio might overlap with that exposure. But really, it's to their benefit that they keep the money on their platform inside the wealth management firm, and they try to convince them to invest in a REIT or a real estate fund manager and say, hey, don't get your hands dirty. Go through something that's more liquid, that's tradable, et cetera, and keep it under our asset advisory wrapper agreement. And that way they get to charge the client more on fees. And the truth is that a lot of clients, once they get to 20, 30 million net worth and up, and even before that, oftentimes want to do direct investments. They want to invest in the building down the street, or buy their own office park, or start investing with multifamily sponsors. So they end up doing so with very little advisory or poor advisory, and it's not strategically done from a high level down. And so the result is right now there's a huge gap in the marketplace of all the ultra wealthy wanting to do direct investments and not receiving a lot of help with it. So we help clients that want to start their own single family office, select the right multifamily office, or they might like their Goldman Sachs provider or the multifamily office they're with now, and we can help them develop a direct investment allocation program and help advise them on, strategically really focusing on what is the game that they want to play now that they've had a liquidity event, now that they're worth, X amount. What are your unique abilities and capabilities, and where do you want to go with that over the next decade? And I think that's something that we really don't see too many others providing in the marketplace. So we don't really worry about other firms trying to offer something similar, because, for example, even a Goldman or UBS, et cetera, when they have direct investments, they're going to be syndicating a deal among 10 families. It might be all 100 million plus families, but if not one family is being shown that large asset, unless it's a very large asset. It's not really worth Goldman's time to get their hands dirty on a $10 million apartment complex for one client. That just doesn't happen on the direct investment side.
No, it definitely makes sense. And what I found interesting is you've been basically particularly focused on one area of the market. And it's something you called, it's called centimillionaires market, right? So it's families worth over $100 million. And you provide some interesting stats about this, where Bloomberg has, at least they state, there's 3,000 billionaires globally, right? And we always know stories about billionaires. We see them all the time, right? But there's over 40,000 of these centimillionaires who are institutions, net worth, again, more than 100 million. And when you're looking at this, and you brought it back to Bloomberg here, they have 12 full-time reporters there dedicated to writing stories about billionaires, but 0 covering centimillionaires, which creates a big advantage because this is a massive market. It's much bigger than billionaires. So you actually wrote a book about this too, right? Centimillionaires migraines. Talk about that market, because you're right. It's something that you don't hear about. And I bet you they like that, right? Because once you're a billionaire, you're going to get exposure. It's an easy headline. Everybody knows about you. But it's almost like you're going to hide under the radar, but you still need like a lot of financial advice. Is it better to target this market, not just because it's much bigger than billionaires, but what are you hearing? Because, like, again, it's a market that seems like it's untouched, believe it or not.
Yeah, it's not only 15 times larger than the billionaire market, but these people have less gatekeepers, and there's many more of them, and less people are chasing them because they're not so famous. They're not the titans who, own the Dallas Cowboys, that, get in trouble and are in the newspaper or something, right? They're like people that no one's ever heard of. So there's all these different factors. And I just think that just like family offices in 2007, in the future, there's going to be a lot of information out on this topic. And I think that the individuals who are worth 100 million plus have distinct needs from others. If there was a word for 50 millionaire, I would have gone with that, because the needs definitely start at 30 to 50. But over 100, you're paying for a family office, whether you have one or not. You're just paying for it in lost efficiency, lost opportunities, wasted time, things done in a more stressful manner that should be done by a high quality solution provider at the same or lower cost. And so at the 100 million plus level, you really do need a family office quality solution. And I think that is part of the message in the Centimillionaire Migraine book. But a lot of that book is just explaining that if you don't have all 6 of these headaches right now as a 100 million plus net worth family, it's almost inevitable that you're going to have at least 4 or 5 out of the 6. So you might as well guard against them, mitigate the risk of them, and apply some thinking models and practices and tools to kind of protect your family from what could, hurt family relationships or hurt your net worth.
It's funny because a lot of people might be listening to this saying, wow, I wish I had those headaches because I have so much money. But like you said, it is about playing defense. And it's just the level that they're at in terms of investing in the right areas, like you said, if it's a $10 million real estate project, or getting the right advice and getting everything under control. And the fact that you handle that is such an important thing. And I guess it's going to lead me to my next question here, because you have a podcast, which is awesome. It's called Family Office Podcast, where you talk about everything from deal flow, capital raising, marketing, consulting. But I listened to a couple of episodes, and you were saying how some of these businesses, how it's a subscription newsletters, which is kind of our business right now, and which is our business, financial newsletters. And you're saying, and this was, I forgot, I don't know if you named the type of business it was, but you used like $100 million as a company. This is where they want their sales to go. But you talked about different ways of giving them advice, where it's not just giving them advice, but you said, you know what, I'm not going to charge consulting on this. It might, for us, we'll rather get like a small equity stake in the business and help them out this way. How do you determine that? Because getting equity stakes in businesses is fantastic, but also it might be better to just manage it, the whole entire family office.
Right. Part of it is depending on what is best for the family and what they're looking for. Some families are set up very professionally already, and all they need help with is their direct investment program. And really their focus should be so narrow that really our work is going to be strategizing on their focus and then helping them originate that deal flow. And in those cases, we can be pretty lean on what we would charge on a retainer or a basis point fee, and have it be more focused on carry and performance or an equity partnership with them. Other times, like right now, we're onboarding a $128 million family, a $310 million, and a $500 million. And with all 3 of those families, they have a lot of work to do. They have a lot of trust and estate planning to do. They have assets that they need to prepare to get out of. One of them has to refinance a large portfolio. There's just a lot of oversight needed, and a lot of hands-on help and introductions and coordination needed. And then we'll get to the direct investment program, but it might take us 3 to 5 months just to get through some of the basics of where they should be going and why, and how things should be structured. And so different families have different levels of heavy lifting needed. But a consistent thing is a lack of a formalized direct investment program I found. And then there's a spectrum of how much work is going to be needed to get things cleaned up, such as proper financial statements, accounting, tax advisory, estate planning in place.
I'm going to take a stab at this, but I'm going to say, what is the number one question? And if I'm wrong, you'll let me know. But what would be the number one question that they ask you for in terms of service, in terms of investment advice? Because if I had to guess, it would probably be, how can I generate the most income with zero risk, right? Because it seems like that's what again, it's protecting, it's defensive. And that's why the housing market exploded with CDOs, because they would, hey, AAA ratings, there's no risk on these things, and you're getting high interest payments. Is that one of the things that they ask you, or is there certain, outside of what we're looking for in an investment opportunity?
Most of them are not, they're not overly concerned about the income. A lot of them are sitting on so much cash. They have more than enough cash to not even be worried about the income. A lot of them need to watch what their burn rate is and match their income against that to have a sustainable level of assets. But a lot of it is about getting the right trusted partners around them and how to get a model in place that allows them only to do what they're best at doing and what they want to be doing, not having to deal with things that they're bad at doing that cause them stress, chaos, disorder, distraction, and a lot of things they get sucked into are not related to what they're passionate about or how they create value in the world or how they create additional wealth. So whether or not they say it directly, almost everything that they come to me for is a symptom of or a result of or is very closely related to the fact that they don't yet have that model and set of processes and systems in place so that they can just focus on the game they want to be playing and what they're excellent and passionate about versus, being sucked into all the different things that are needed to help manage their wealth.
So I want to ask you this because, we were talking about Set of Millionaires here, and if I had to guess, less than 5%, right? That was less than 5% of my audience, probably less than 2% of most audiences, if I had to guess. But what advice would you give young investors? And you covered it a little bit before, but what advice would you give them now that you've talked to so many people in this industry that have been successful? Would it be to take more chances? Is it, hey, guys, focus, build your network early, or when you're young, or is get a major degree at a college? Because we do have a lot of young listeners here too, and a lot of these people, which I listen on your podcast, and makes sense to me. These are self-made people. This isn't like, money passed down to them, where they came out and they found something that, again, they had a niche market that they conquered and they benefit of and are very successful. But for our young investors, what is something that you would tell them based on everything that you've learned?
Definitely. I have to be careful nowadays when you're recording something, giving blanket advice. Obviously, it's not generic investment advice, but on the career business advice side, I would say to find a niche area where there's an overlap of where you think there is a lot of money to be made, you're passionate about it, and it plays off of your natural strengths, things that you're naturally good at, things that you've done before and you've experienced at, and to find that intersection based on all the potential opportunities in front of you and to screen things very heavily through those lenses. And to not be following the crowd, but figure out how you can be in a position so eventually you'll be leading the crowd or leading a trend or dominating a niche area or kind of monopolizing a very focused area. For example, we help people that need marketing materials put together for investor relations through our pitchdex.com agency. And we several times now have helped investment firms on a parallel thinking track that I think many people are in business and their careers, where someone will come in and they say, oh, well, we do commercial real estate investments in Florida and New York. And we say, okay, well, which do you do more? Which do you do the most of? Where are you based out of, et cetera? And it turns out they might be based in New York and their biggest expertise is self-storage, for example. And so instead of going out into the world and saying we're a commercial real estate firm focused in New York and Florida, and then the investor or someone hears that and says, okay, well, I know 5,000 people that are in commercial real estate in those states, so why do I care? What deals do I send you? What opportunities would we work on together? Instead, it's night and day different, saying that all we do is invest in self-storage in Manhattan, or we only invest in self-storage in New Jersey or in Queens, et cetera, because it becomes so much more credible and clear that you could realistically become an absolute expert on every self-storage location in Queens or in Miami, et cetera. And you can cover the deal flow there. You can figure out who the asset owners are. You can know the market like the back of your hand. And I know a $1 billion plus group that's done this with office parks within half a square mile of Times Square. And I think that their advantage has been that the most expensive real estate in the world is right there. And there's a lot of highly competitive firms going after projects there, but almost nobody else globally, no one else I've ever heard of, only buys real estate there. And because of that, they're going to know the owners better. They're located right there. They also do leasing and maintenance in that area. So they can dominate and have an advantage over others because of that laser focus. So I would just encourage people to have that focus. And when anyone's giving you advice, I would just look at what they actually do and not what they tell you. And that's how I built my entire business, is by focusing on family offices, helping single family offices, helping people wanting to start their single family office, and the centimillionaire area. Those are all different niches within the same niche. And I keep on uncovering another sub niche that's underserved, and I can put a flag in the ground and serve that niche and, hit a target group that's highly valuable right between the eyes. So I think that'd be my most valuable advice, because that's what's worked for me, and it's the recipe we use over and over again.
And I want to finish with this, because I noticed that you have professional designations where you're a qualified family office professional, but it also says that you're a certified capital raising specialist. Now, how did one become a certified capital raising specialist? Because I'd never heard that before. And that has to be one of the most powerful things in the world, since at the end of the day, 99.9% of business is always looking to raise money. I'm just curious. I'd never heard of that before.
Sure. That's something we've developed over the past 10 years. We've had about 6,000 professionals go through our capital raising certification, our family office certification, and some of our others. And essentially, it's a self-paced online certification program to basically teach people the fundamentals of how to raise capital in a modern way, using digital media, using attracting investors to you, using a lot of the things we've talked about on this podcast, actually, figuring out what niche audience you want to appeal to and then position yourself as well as possible. And we do 25 live events a year, and half of those events are capital raising workshops where we go through intensive, fast-paced, small group exercise trainings on capital raising. The other half are investor summits. And the capital raising certification is so that somebody in Hong Kong or Australia who can't come to our live events or just doesn't want to travel to them, et cetera, can just do the program online and get the level 1 certification online. But we also do the training in person, and we offer 3 different variations on the workshops. We have one called Capital Raising Catalyst, which is the fundamentals. We have one called Investor Influence, which is all about persuasion and effective communication. And then we have one called Marketing Material Mastery, where we go over the 14 different pitch materials you should have in place, and the 9 different marketing materials that could help you be more effective at investor relations and raising capital. And we encourage people to, complete several of those programs so they have a really well-rounded kind of specialist knowledge on raising capital.
That's great stuff. So you, like I mentioned earlier, best-selling author, you have an amazing podcast. If somebody wants to find out more information, more interested in your services and learn more from you, how can they do that?
Well, most important thing to know is that we've built our whole business based on just giving away a lot of information. And if somebody wants to engage in person or get help on something hands-on, then we might charge money for that. But we try to make it very easy to get to know us and just add value first. So if you are in the investor relations or capital raising world, I've got 80 pages of advice for you at our website, which is capitalraising.com. There's a book to download. It's the same book, which is my best-selling book on capital raising on Amazon. In case you just want it in paperback form, we sell it for $3 or $4 there, as cheap as they'll allow us to. We then, if you're new to the family office world, and whether you want to start a family office for your own family, or you want to just learn about the space to see how you could raise bigger checks at a time and raising capital, you can learn about the space at familyoffices.com. We've got a free book on family offices there. And we also have our schedule of our 25 live conferences this year just on the homepage there of familyoffices.com. So I encourage you to check that out. Our membership model is like Netflix. It's $299 a month. and it's month to month. You can cancel anytime. There's no long-term lock-in contracts. And we've got about 1,000 members who think it's worth it to be a member and come into the events and workshops. And right now we've got a $99 first month promo as well. So if you go to familyoffices.com, you'll see that the first month you're paying $99 and we're losing money on you coming to your first event because we know most likely you're going to like it and be a member for a long time to come. So we just kind of take that hit up front and try to take the risk off the table for people.
That makes a lot of sense. That's what people do. They give away free stuff when they have good products, right? Which is really cool.
Right.
So Rich, listen, thanks so much for explaining this. I mean, it's so many different levels, and I'm hoping that this interview went where we're not focusing on necessarily family offices, but how these people operate, how they operate their businesses, even for the younger generation, and how everything really comes together. And hopefully that came out, and I think it did. But I really appreciate you taking the time to come on the podcast and explain it.
For sure. Yeah, thank you. Thank you for taking the time as well, Frank.
All right, guys, great stuff from Richard. I mean, I love that interview. Just want to give you a different perspective. And I always say this podcast is about you, not about me. So I want to let you know, Frank at CurzioResearch.com. Let me know what you thought about it. Okay. Sometimes I'll like things, but for me, I loved how he talked about the investment strategies of the wealthy, how most of them are self-made millionaires. So they really work their ass off to get where they are. I love how I talked about the traits they have in common. Yeah, they want equity ownership. Want to look at places they have a competitive advantage, almost where it's kind of like a monopoly. How most are not that conservative, which surprised me. I figured, hey, you're rich, just let me make sure I got this income. He did talk about cash burn. But no, they're always looking for the next big idea, which is awesome. And I'm going to reach out to Richard since we're raising capital for Curzio equity owners and our token. He has lots of access to high-profile investors. I know some of them, they're always looking for exposure into alternative assets like a digital security. I also have meetings set up into next week with institutions and funds who want to learn more about our token. And I may be flying in a couple of weeks to either Hong Kong or Dubai, where one firm that I talked to yesterday is going to set up a conference just for us, Curzio Research, and they're inviting anywhere from 15 to 30 family offices and funds. And they've been screening only ones that express interest in actually, becoming investors in my token, have read everything. But I'm going to be pitching my company to them and talking about the financial newsletter industry, which a lot of people don't know about, or the margins, or how scalable this industry is, because most companies are private. I mean, it makes sense when you talk to people. People do not realize how big the financial newsletter industry is. They don't realize it's easily over $2 billion a year industry, easily, with incredibly, incredibly high margins. I mean, when I tell people that, it blows them away. I'm like, yeah, that's how big it is. So lots of meetings planned, and that's why I said, if you're still interested in investing in our token, the 28th was the last day I can guarantee a discount to my listeners and subscribers, because that was our private sale, which I promised that it was only being open to my file, and nobody outside of our followers will be able to invest in the token. But you're still going to get this discount as long as the offering is open, right? So we're at $4 million in capital raise. Our hard cap is $12 million. It could end soon. I mean, with the investors that we're meeting, and we may not hit the 12 million, which is fine, because if I'm meeting with some of these funds, and I've heard this with past crypto funds, I haven't experienced this yet. Talked about 2 or 3 institutional investors, but some of them just, hey, give me a 30-40% discount on the token. Why? So you get the token at $3 instead of $5, and then blow out of it day one. I mean, it's not in our best interest. It's not in the companies, the investors. My name's attached to the company. My friends and family are in it. And if that's what I'm going to deal with, then no, then we won't reach 12 million. It's fine. But that's why when we're sending out emails saying, hey, we can't guarantee it, because once we fill the 12 million, it's over. But we could guarantee in the first 2 weeks of the private sale, and now we're going out to everybody else. So, guys, listen, we're still getting questions of people being interested. If you are, just go to www.CurzioEquityOwners.com. Make sure you read everything: white paper, safe agreement, FAQs. We have an investor guide there. I have investors talking to us, talking to me personally. If you're a serious investor, you have to be accredited to go in this. But, everyone on our list, our file, gets a 10% discount, which means that you'll be able to buy the token at $4.50 instead of $5, because, that's my way of giving back to you guys, anybody that wants to come in as an investor. But again, I talk to a lot of you personally. If you want to learn more, just go to www.CurzioEquityOwners.com. Now, today's podcast is running a little bit long, and whenever I run a long podcast, I try to make sure the content is really, really good. Hopefully, it's been good so far. I think it's going to get even better. I rarely do 2 interviews in one podcast, but again, so many incredible people have been reaching out to us. And I mean, I've been planning, even these 2 that I planned weeks ago, some are planned months ago, and that's thanks to you. I mean, word is spreading about the podcast, word of mouth, and a lot of great guests are coming on. And that's what led us to Chris Gessel reaching out to us, who's a chief strategy officer at IBD. It doesn't get much better than that because he is old school. I mentioned before, he's been at IBD since 1996. So he's going to be sharing some amazing stories and also ideas with you. So guys, be sure to have a pencil and paper handy and share at least 5-6 different ideas with you. Really, really cool. And let's get to that interview right now. Chris Gessel, thanks so much for coming on the podcast.
Frank, it's great to be on with you.
Well, listen, I'm honored to have you on the podcast because you're someone who I like to say old school in a positive way, where you've been pretty much at one company, right? IBD since 1996, which means you've lived through several boom and bust markets, right? And you know, we have even the younger generation where they read about them, they think they know it, but it's a lot different going through this and going the emotions behind it. And you guys have so many formulas and strategies with IBD and how to predict growth, how to get out of the market when it's bad. Talk about what's changed through IBD of what you learned over those years, because I think it's such a valuable lesson, especially for young investors out there.
Well, there's been some kind of nuances in when stocks start moving and things like that. But overall, I think the big takeaway is things haven't changed. I mean, the market is acting the same. It goes in and out of, like you said, growth cycles or uptrends. We still see that the time to buy is when the market's in an uptrend, and we have some tools to let us know when a new uptrend is emerging. But really, if you stay in sync with the market, that's the biggest overall factor in your success. And we spend a lot of time looking at the market every day and understanding what it's doing right now. We're not really trying to make calls like we think it's going to be up 20% this year, or we think it's running, for a number of years. I mean, we have ideas about where we think we are in the cycle, but really it comes down to what the market is doing every day, and then everything else goes, follows from that.
So what do you think of the market today? Do you look 6 months out, 12 months out, and how does that factor into your strategy? Because I've argued where right now it's kind of a Goldilocks economy, right? If you talk to 10 people, 5 of them are going to tell you that, well, you got tariffs and you got, our debt and all these risks, and we're a little expensive. We've been running up. And even though, technically we're not really that expensive, looking on a forward PE basis. And then you have others that in the bullish camp saying, things are great. The economy's better now. USA is the best. So how do you, what's your strategy in order to determine if it's the proper market to invest in, which is going to basically result in what stocks you're going to pick for your portfolios?
Yeah. So, I agree with you. I think that we're in a decent economy. Things are growing. Sure, there's risk. The biggest one is trade right now. It seems like, the Fed is off the table, but they've, backed off. But so in general, we're positive about the general economic backdrop. And then technically, in going to what's happening in the market. So we just, at the end of December, we bottomed from a bear market. Definitely, the S&P and Nasdaq were below 20% for a number of days. We haven't had something like that in a long, long time. And so, when we see a correction, we a lot of people get dejected by corrections, and they lose focus, and maybe they're not paying attention so much to the market. But, we get really active in the sense that corrections build the basis for the next big move up. And so when the correction was going on, we were looking at our screens every day and finding these stocks that were doing much better than the general averages. And so their relative strength lines, which plots their performance versus the S&P, were shooting up higher. And so those were stocks that were on our watch list and just drawing attention to them. And then when the market turned, right around Christmas, and then we got a follow through, and a follow through is when you get another big move in the market that confirms what you're seeing, previously. We, now the buy switch is on, and we were aggressively going back into the market and talking about it, and as well as in our premium stock picking products. And so right now we're in the early stages of a new rally coming off of a bear market. Now, today the market's pulling back a little bit, and that's normal. But we really come off a lot off of the bottom, which is normal, and it's looking good.
So now you say, okay, the market's looking good. Now, if you could take us, and I love this because I think this is really cool. Could you take us how you select those stocks? Because I would guess if, when we do hit that bottom, you determine on technicals, and like you said, the market tends to bounce back. It forms a nice bottom. Maybe you want to get more aggressive in growth stocks, or is it, you're looking at the market and saying, okay, maybe it's not done yet. Maybe we go into consumer staples or utilities, opposed to maybe going into, as an extreme example, FANG stocks or the biggest growth ones. How do you determine, which stocks are you going to pick? Is it, these are the ones that are going to go the fastest, or it's a kind of like conservative? But take us to the process where now you have the idea of where the market's going. How does the stock selection work?
Well, we're running screens on the market all the time, and what we do at IBD, it's kind of unique in that we combine fundamentals, which is our first screen on the market. We're looking for companies that have great earnings and sales growth. They're doing something special in their industry, or at least there's some move going on in the industry. And then we apply, a technical overlay. And so we're looking, are they making consolidations? Are they already outperforming the market? And then when those stocks start breaking out, we're buying them on those breakouts. And we have rules on, when to hold them, and profit-taking rules, and, taking 20 or 25% profits on a lot of stocks, and then letting the others that have really spectacular earnings and sales growth, those could turn into your big winners, where they might be up, 100% or 200% in the year, and could really begin a major up move. So that's the kind of the overlay. And really what it is, we have a lot of tools on the site, and some of our products like MarketSmith has a list called the Growth 250. We have the IBD 50 in investors.com, our website, and in our newspaper as well. And so we've got all these lists that are looking for really strong stocks in terms of fundamentals that are also outperforming the market. And so you get this small cadre of stocks that somehow during a 20% bear market are actually pretty near new highs, even when the market turns out. And those are usually the first ones that break out, and we're jumping all over those kind of stocks.
No, that's great stuff. And, I want to also go back because it relates to what we're talking about here. When I think about what you started, and I was in the business back then as well, and that means we're young investors, I guess, right? But
right.
When you go back, I remember back at that time, there wasn't a lot of people, and even with IBD, it was kind of like foreign to people, where you guys were talking about growth strategies. And people, I felt like back then was so much into value. You probably remember the value line was, it's still around, but it was like the Bible of the industry.
Sure.
You remember, it used to be you get it mailed to you in little clips with a bunch of stocks and one-page write-ups and stuff like that, But how was it back then when you're explaining growth? Because now, I mean, we've been in a very, I would argue, a bull market for growth for a while compared to value. But a lot has changed now, right? It seems like there's so many people in value. But back in 1996, I don't know if there was that many people in growth, right? Was that a hard sell for you guys back then, even though the internet was really like getting going back then?
Not so much. I think there's always been, two camps on Wall Street between, you've got your value, your investors, and then people are more aggressive, going for, the things that are seemingly high price, but they're growing faster, so they're high price for a reason. And there's always been that dichotomy. Definitely, I think that among let's say, in general, people like getting bargains. And so there's a natural tendency for most investors, at least to start off, being more value investors, because they like the idea of buying low and having a stock rebound. Our approach is, if you buy right, you're buying at a high and the stock goes higher. And, we've got all sorts of examples from decade after decade of how stocks perform that way. In fact, that's how Investors Business Daily came about, because our founder, Bill O'Neill, back when he was a stockbroker starting out in the business in the late 50s, early 60s, and he didn't want to just be an above average stockbroker. He wanted to be the best. That was just his approach to everything. And so he started looking at what the best stocks in the market, how they looked before they started rallying. And he, started pulling together data and charts and kept seeing all these recurring themes where you had lots of great earnings growth, and then the stock was probably building a consolidation going sideways, often because the market is correcting. And then as soon as the market turned up, these stocks that had these criteria of great earnings and sales growth would bolt out first. And that's how he got onto it. So I would say, when I started back in the mid 90s, IBD had already been around more than a decade. And I think that idea was getting out there more. But in the general population, it's still a tough sell at times to say, really, the time isn't to buy when a stock is down below its 200-day moving average. It's when it's hitting the highest price that it's ever traded at. And there's definitely times it's not just any old new high. It's when it's been going sideways and then it breaks out. But a lot of what we do goes against human nature, and so that's where rules and come into play, because so many problems that people get into in investing have to do with emotions and how they want the market to be, and this is really based on how the market acts, not how we want it to act.
And I love this conversation because even when I made that mistake where I grew up as a value investor. My late dad was a value investor. And then I worked for Jim Cramer for 5 years, and he was pure growth. So I was able to get exposure to both, and it gave me a great understanding, 2003, 4, 5, 6, around there, of how, growth is, I don't want to say everything, but it really means a lot. So, and it even came to the point where I missed companies like Apple. People forget about Apple, and even, Netflix when they were getting started. And looking at 2004, Celgene, these things were trading. The typical way we measure stocks, I shouldn't say that, but that's the standard out there, I guess, kind of is the PE ratio. And if you look at them, Apple was trading at 50 times earnings back then. Netflix was like 100 something times earnings. Those stocks are up, if not thousands of percent, maybe even 10,000% plus. How do you explain that to them? Because that's one of the things I think investors have trouble with. When you recommend the stock, they immediately look at the PE and say, wow, it's a PE of 60. This is crazy. But you have to look at the growth in that, right? I mean, so how do you explain it to investors who kind of have that stubborn mentality where they're like, oh, this is too expensive, I'll never touch it, because then you miss some of the names, like the FANG names from 10 years ago, which I know a lot of, you guys have been in.
Yeah. I mean, if you're focused on PE ratios and other value metrics, it is highly unlikely you will ever get one of the big winners in the stock market that will go up 1,000 or 10,000%, or in the case of Cisco, 80,000%. And the reality is that when stocks are showing, or companies, I should say, are showing really powerful growth, and Wall Street is, looking at it, and they're trying to get on ahead of time, typically the price runs up ahead of the actual growth. And so you'll get these really high multiples. But what happens is that they continue growing. And not only do they continue growing, a lot of times they start growing even faster than expected. And that's when you get these massive moves, like with Apple, that was, a dog stock for years and years. It just, it was the ugly duckling compared to Microsoft, and then they got their business in order and things took off. So that's just how the market works. And actually, that you asked me early on how things had changed, and I would say that Wall Street looks even further out and will start jumping on a stock before maybe the earnings will come in a lot of times. And so we'll see that with a lot of IPOs that come to market. They may not be profitable, but their sales growth is in the 30 to 40% range quarter over quarter. And so then that's where you get these younger companies that really start taking off. And if they don't deliver on the earnings growth, then they'll falter. But if they come through with that earnings growth, that's where you get these incredible new stocks that just make great gains. And one of the recent ones in memory is Square, the payment company. And, it's a great example of it came public. It wasn't it wasn't profitable. Sales were growing quite a bit, and it made a base and tried to break out and then went sideways. And then in 2017, it really started moving. And from around, $15 a share, it went to over $100 in about 2 years. So that's the kind of thing that we're looking for, where it's a new company. We know people are using the product, and the numbers are backing up, the story, and it's really working.
Now, a lot of this too, you can tell is based on technicals. Has anything changed, say, in the last, you can even go back 5 years, where algorithms? So for example, we have a company in our portfolio called Air Environment, and they just came out with good earnings. And that's not why I'm highlighting. I'm highlighting the reason is, so it was up 7% last night, and now it's up like pretty close to 20%. And you'll see some stocks where they'll report weak earnings and maybe not too bad, and they'll open up down 5%. Next thing you know, they're down like 15, 17% for the day. But it seems like these moves are accelerated, which may trigger some of these technicals. Have you noticed that to be difficult, where you want to be able to take profits and limit your losses, but it seems like sometimes these moves are getting more extreme. You've seen a lot more volatility these days. I wonder if that's impacted anything with you guys.
Yeah, there's two elements to that. I would say overall, when I look at a chart today, and I can go back and look at charts from 20 years ago, or when we were first starting, actually the charts look the same. There's really nothing different. There's always something happening technology-wise that then people blame on why their stocks aren't working, and whether it was hedge funds in the 1990s, or high frequency trading now, or dark pools, things like that. There's always something going on. But when you step back and you look at these companies that actually deliver on the sales and earnings, their charts look normal. Now, the other part of your question is volatility around earnings, and that definitely has changed, and that has to do with regulation, FD, full disclosure. And again, with a lot of well-intentioned changes, from regulators, there are unintended consequences. And so when I started, you would rarely ever be in a stock that was acting well and had broken out, earnings came out, and it would just continue higher. And the reason was there was always a little bit of information coming into the market, either through road shows or calls with analysts, things like that, and the company would tip off Wall Street, like, maybe things might be a little softer, and so the chart would reflect that news before earnings came out, and so you wouldn't necessarily be in a stock that was going to report bad earnings because it had already triggered a sell rule. Now, today, companies are really limited on what they can say, and if they say anything, they have to say it to the entire market all at once. And so a lot of companies have just said, okay, we're not saying anything except on our earnings calls and our earnings releases. And so that's why we're seeing such volatility around earnings reports, which is great when it goes up. We all love that. But when it goes against you, and you're up 10 or 20% in a stock, and all of a sudden you're underwater, that's a bad feeling. So I'll tell you one way that we've come to deal with that volatility is by using options. So instead of buying a stock outright before earnings, we would buy a call option. Usually you can buy a very short dated option, like a weekly option, or maybe a monthly, it just depends. And in most cases, you can buy the option, and if you take the premium and look at it in terms of the overall stock price, if that stock plummets on earnings, the most you can lose is the premium. So on a $100 stock, if the premium is $4, you're risking 4%. Now, for people who know about IBD and Bill O'Neill and Can Slim, we typically don't want to take any loss greater than 8%. We try to keep them smaller. So if you think a stock is going to blow out on earnings and take off, buying a call option ahead of earnings can make a lot of sense. And a lot of option traders would say, oh my gosh, that seems like that's the worst time to buy a call because of the volatility is so high, and then you get the volatility crush after earnings and things like that. But we're coming at it from a different way because we're, applying our edge, which is, okay, we see a stock that's in a base. It's got, has a history of good earnings and sales. Maybe they're accelerating. It's still fairly early in its run. We think that this is a good risk. And so we'll go ahead and buy that option. And then really the whole idea is it's not to profit from the option, it's to get in the stock and exercise that option.
So, Chris, you said something interesting there because you tend to not like to take losses more than 8%. But even with a company like Square, and I see it not just with Square, but everybody, and the reason why I bring up Square is because we have in our portfolio, I think we recommend around 40-ish and doing well. Okay. And when I look at Square through this whole, this is a company that had several moves, sometimes daily of 8%, where it would come down on its growth trend way higher. And then, of course, it came down. Is it getting in and getting back into it? Because like I said, with today's volatility, sometimes you'll see some of these stocks, if just technology's out of favor, if they start talking about Facebook and privacy issues on the hill, then all of a sudden you'll see some of the FANG stocks. Some of these things come down could come down 8% in a day or two. How does you manage that? Is it getting out and getting back in? Because for me, it seems like that it's difficult, and a lot of this, as you know, is just noise. But is it worth getting out of the position, getting back in? How do you play that because of the huge volatility, especially in technology?
Well, the 8% rule is based on buying at a proper buy point. It's not just anywhere in the stock's run, and we would never sell a stock just because it fell 8% from a recent high. That's not a reason to sell. So it's when a stock is consolidating, it's and there's a clear buy point resistance area where if it crosses that in volume, then you should be buying. And if it's going to work, it should not fall 8% from that buy point. So that's where the 8% rule comes in. So in the case of Square, it's gotten a lot more volatile, especially during the correction. It pulled back 50% from its high. So and we would be, we would really be focusing on this stock in those bases in 2017. It got a little wilder. There was another base that we focused in on last summer in 2018 that led up to the peak around 101. But so that 8% rule is in terms of a buy point, not a
got it.
Falling from a high or something like that.
No, it definitely makes sense. And I love picking your mind about this because, just to see that strategy up close, we all read about it in IBD, but just to have someone here and explain it in detail of exactly what you're looking at behind the scenes. I know my audience really appreciates that. Now, I want to get to the markets because you have an interesting opinion on it right now. You're saying it might be in a new phase. It's been prolonged sideways action. So most people, when it goes sideways, they don't consider that a bear market. But you're kind of saying that we might still be in the early stages of a new bull market. So explain that, because a lot of people are nervous right now, thinking we're kind of by a top, and you're saying, wow, the market looks positive. We may be entering a new phase of this bull market.
Well, the first thing to remember is we just had the NASDAQ was down 23.9% from its high. So a 24% bear market. That means the bull market from 2009 is over. That was the first true bear market where we had closes of more than 20%. We did have a pullback in 2011 where intraday, I think we got below 20% for about 15 minutes or something like that. But, this is, there were, a number of days below that 20% level on the NASDAQ and S&P. So just by that factor, the the bull market coming from 2009 is officially over. However, one of our portfolio managers in our sister company, a guy by the name of Mike Webster, very smart, really analytical, and he has been arguing that the consolidation that we saw from, I don't know, I guess it started in July of 2015, and that was the top of the market before we had an 18% correction in the NASDAQ, and then it came back, and it didn't quite make new highs. And then going into 2016, that's when there was fears over weakness in China, and the market sold off again. We were down almost 19% in February, March, and then the market started coming up, and we got one more scare in June with the Brexit vote. And so really that meant the market was going sideways for more than a year. And we saw that, in the Russell and all the other indexes. So a prolonged period where no one was making any headway. There were some truly sizable intermediate corrections, probably nothing big enough to be counted as a bear market, but still time has a lot to do with resetting the market. So we've gone sideways, and then Brexit happens. There's a big sell-off, and now the market reverses, and now we're running. And really, his thesis is that was the true reset. Now, if you disagree with that, then we come to what we just saw from October to December. That's a bear market. Bear markets end bull markets. So we are now in the beginning of a new bull market, at the very least. And if you look at maybe, comparing how the NASDAQ and the S&P, this is a much bigger analysis. But if you look at how the NASDAQ has acted since its major top back in 2000, and you overlay that with the Dow Jones in 1929, the similarities between the two markets are very apparent. Especially the initial sell-off, they are almost mirror images, and then they were really following each other as they were recovering. Then there was a little bit of divergence. But what Mike has noted recently is in the late 40s, the Dow Jones really began a major uptrend and went from, probably around 200 to 1,000 by the early 60s. And we're kind of in that same period where we came up near the old highs, pulled back, and that was in 2015, 2016. And since then, we've made a really nice move, and then we've had another bear market in that period. So, you could argue that it's still in the early stages of a major new bull market. Regardless of whether you believe that or, you just want to go with, okay, we had a kind of a garden variety bear market, and now we're running up. At least the short-term outlook for stocks is very positive. We're kind of leaning towards, maybe there's more to this, and that can inform, how aggressive you might be. However, how we started our conversation is, if the market starts telling you something different, you need to change your outlook, because anytime you argue with the market, that is an argument you're going to lose. The interesting thing is that when the NASDAQ and the S&P come up to their old highs from October, and right now we're about 7% off on the NASDAQ, that will be a real testing point to know whether this idea of a major bull market in effect is true or not. Because if we come to that level, and we'll probably bounce around a little bit, but if we can, break through the 8,100 level and, start pushing towards 9,000 on the NASDAQ, that's a pretty solid piece of evidence that there's something more going on than just a rebound from a 20% correction. So I think that we're really, curious to see how the market acts around that point. And if it can break through, I think that's when we'll get really aggressive and, be going out on margin and things like that. But right now we're just having a normal pullback in the market. It's been, strong coming off the bottom. We've been expecting it to bounce around, and we've been seeing that for about a week and a half now. So we'll see where it goes from here. And like I said, we watch the market day to day and react to it accordingly.
So I don't know if you're allowed to share any ideas because we covered so much and I love it. And just go into the methodology, the markets, and what you look at. I appreciate it because you're breaking it down for everyone to understand, which I know everyone appreciates. When it comes to individual stocks, I'm not too sure if you can give out recommendations. I know you talked about Square, but is there, based on where you're seeing the market go over the next few months and how you feel about this, is there certain ideas that you would share? And again, I don't want you to give us anything away that people are paying for, but just like different ideas where everybody used to buy all the FANG stocks. They were all correlated. We're now you're not seeing that too much. Facebook down a little bit more. Looks like some of the other ones doing, Apple's down a lot, but Netflix is doing pretty good. So are there any individual names that you see based on, your overall outlook for the economy and the markets and, that you guys are playing right now?
Well, I'll tell you, there are a number of stocks, and a lot of them are in the software sector. And actually, software kind of came under pressure this week because they had such a move. But I'll tell you, we do have a premium stock picking service here called Leaderboard, and we've got a number of software stocks, some from the enterprise sector, some from security. And so CyberArk and Coupa are a couple names, ServiceNow, Zscaler, things like that. So I would say right now, software is the leading sector. It's at the top of our industry list, and there's a lot of stocks that have made really solid moves out of these first stage bases, and that means that there's going to be more opportunities, to add to these positions if you already have them. And if you don't, look for new bases or pullbacks to like the 50-day moving average. That's a good place to get in if you've missed the original breakout. So that's something that is really looking good right now. And then, actually we have a feature that we publish every day. It's called the IBD Stock of the Day. It's free. It's open to anyone. And that's where, every day, I sit with the market team and we are talking about stocks. I'm running screens and I'm looking for something that is, acting interesting. There's something interesting about the earnings and sales, and maybe it's in a base, maybe it's pulling back. So there's always a fresh idea out there for you every day to add to your watch list and start looking at. One thing I'd say is, if you see the stock of the day, that does not mean it's the stock to buy that day. It's a stock to watch and do some research and start understanding it. So there's always new names coming out, and it's it's a process of building up a watch list and really looking for things that are showing the earnings and sales growth and the proper technical points. And so when you get, when you're looking at stocks that they're early in their run, they're breaking out of first and second stage bases, those are the things you really want to focus on. Third stage bases, maybe you're just going to go for a 20 or 25% gain. And then we start getting very cautious around stocks that are breaking out of fourth and fifth stage bases. So that's something that we would typically avoid. And because stocks all go through this growth cycle, or I should say leading stocks, they break out, they run up maybe 100%. They might base for a while, and then maybe they'll rally another 50%. And by that time, they might have 3 or 4 bases under their belt. Then maybe they'll have a bad earnings report. They sell off. They spend a number of months below the 200-day moving average, and then business picks up again. So we've seen a number of stocks like that I'll tell you one that we recently put on leaderboard like that, and that is Shopify. So it had a huge run in 2017 and basically had been consolidating sideways for almost a year. And it's starting to show, good growth right now. It's still right around its buy point. If this market continues, the economy looks good, that would be another stock that I would, keep an eye on.
Wow, lots of ideas, and I know my audience always loves that. And Chris, if someone wants to learn more about you, I know you obviously can go to IBD, but you specifically, how can they get in touch with you? How can they learn more about what you're doing, what you're writing, what you're saying? How can they find you?
Well, I guess, we're going to be starting a podcast in mid-April, a weekly podcast, and I'll be on that quite a bit. We're also talking about creating a chat room, and I'm going to participate in that as well, and be answering people's questions during the trading day and kind of looking at what's happening in the market. So that would probably be some of the best ways of directly interacting with me. The other thing is, I'm directing all the market coverage and our stock picking services and everything. So a lot of what you see out there is, at least informed by my thoughts on what's going on in the market. And then if people ever want to reach out and have a question about something, probably the best way to get in touch with me is just call our customer success team, and they can get any messages and questions sent directly to me as well. So I'm always happy to interact with folks.
No, that sounds great. Well, Chris, listen, I know you're a busy man, and thank you so much for taking the time. I know my listeners are really going to appreciate it. And and good luck with the podcast. I've been doing it for a very long time, over 10 years, and I think it's a great idea, and it really connects to people, as a lot of listeners will tell you. But it's a really good idea with the podcast. I think that's awesome, and good luck with that.
Thank you very much. Been a lot of fun.
All right, guys. Great stuff from Chris. As I always say, this podcast is about you. It's not about me. So let me know what you thought about the interviews, about the podcast format. Frank@CurzioResearch.com. That's Frank@CurzioResearch.com. Guys, thanks so much for listening. Really, really, really always appreciate all the support you guys give. I'll see you guys in 7 days. Take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.